Thank you, ladies and gentlemen. Welcome. My name is David Paulson, and it's my pleasure to be here with you and to welcome everybody to our virtual seminar on self-storage. We hope this will be an informative time. We've planned for an hour or so, and we'll see whether or not we are able to make that objective or not. We appreciate your time. We look forward to your input and your feedback. Our format today is going to be pretty straightforward and simple. I'm going to introduce our speakers, and each speaker or each group of speakers will have a few minutes to present a PowerPoint presentation. And then at the end of the presentations, we'll have time for questions and answers. If you have a question during the session, you certainly can send it to the speaker on the chat. And then also, you should all know that when we're done, we'll have a package of the session to share with you, so that if you can't sleep one night and you need a little help getting to sleep, you can pull it out and hopefully find it as informative as it is today. I'm talking to you from Atlanta. We had some horrible storms go through last night, but I hope that everybody in the Atlanta area was spared any damage, and that as the storm goes up the East Coast, people are likewise spared of any damage. Ackerman may be a familiar name to you because I've reached out to most of you over the past few months. We are a full-service commercial real estate company. Like Storage-Mart, we go back to the 1960s, and today Ackerman is one of the larger commercial real estate companies in the Southeast. We do brokerage, we do development, we do property management, investment sales, and we have over 100 professionals who work in commercial real estate transactions. I'd like to acknowledge the team that is supporting us today. First and foremost, Heather Francis, who's our Director of Marketing, who helped put all of this together. And Heather, I can't thank you enough. And you've done such a good job. I'm going to continue to ask of you as we go forward. Keen Miller is supposed to join us, who's the head of our brokerage operation. And then my direct teammates, Steve LaPierre and Wyatt Whitaker, are also on the call. I want to also offer a shout out in a big way to our friends in Baltimore at Trout Daniel, Steve Kornblatt and Coleman Taroni, who actually brought together this family of Storage-Mart in a way by tying us all together. And we work with Steve and Coleman on a daily basis. They've got a formidable commercial real estate company up in Baltimore, and we're happy to share this adventure with them. So first up at bat today is Alex and Mike Burnam, and introducing somebody or people from the Burnam family to others in self-storage is somewhat idiosyncratic, I think, because the Burnams are the founding fathers, if you will, of the self-storage industry, certainly as we know it today. Mike is the company's chief executive officer, and Alex is the company's director of acquisition and real estate. This family has created and sold and recreated more self-storage businesses than one can imagine. In learning about their family and about their business, I found out it all goes back to 1972 with a $10 acquisition, which kicked it all off. And today, Alex and Mike, if I counted my toes and fingers satisfactorily, you're in 18 states with over 200 stores and growing. So hats off to you. I'm going to turn it over to Mike and Alex. One thing that Mike may address at the end of his comments is in anticipation of an upcoming election. You may have heard something about this election. In anticipation of the election, he may want to comment on what happens if candidate A wins, and what happens if candidate B wins with regard to the self-storage industry. And he's going to do all that without telling us who his candidate is. So let me turn it over to Alex and Mike. I'll do what I tell some young brokers often. The best thing for a broker to do is to not say anything. So I'm going to follow that advice for a while and let Alex and Mike carry the torch. Gentlemen.
Thank you. I think they've already learned more about me than they care to, but I think a lot of you may have heard us speak someplace else or read our resume, but if you go to the first slide, please. Second slide. Okay. You know, I generally start a lot of my presentations with this slide, just kind of showing you where we came from. And David was right. Yes, Dad bought our first beginning of self-storage business by spending $10 on a lease he bought from a guy in the Gulf Coast of Texas. And that kind of started us on a roll. If you start to look at everything here, we've sold out of this business 4 different times. We've got about 15 or 16 stores we've bought and sold 3 times. We're self-storage junkies, for lack of a better term. And he was nice in saying that the first family, I think I'm just an antique in the self-storage business. But some things I want to point out to you, I think most of you know that we were private for a while, went public in '94. Public Storage launched a hostel on us in '99. They took over the company, and it was a $600 million check they had to write. And the amazing thing is that was in 1999, and today we have about the same number of stores as we did then. The difference is that 600 million has grown to 2.7 billion. I have often wanted to go back and looked at the stores that Public Storage took from us and go through their numbers and try to find out if the ones they bought from us then are worth as much as what we have now. It's going to be an interesting exercise someday. But in between time, after we learned our lesson with Public Storage, we then launched a hostel on the only publicly traded self-storage company in Canada, took them over in 2009, and have since grown the company from there. We've been very fortunate to have some very patient, very high net worth investors, all culminating here in the last 3 weeks, really, with Stan Kroenke, who is a local boy from Columbia, Missouri, who has done very well, owns the Los Angeles Rams, the Denver Nuggets, the Denver Avalanche, and the UK Arsenal, which, by the way, is the main reason why we're also in the UK. Due to his involvement there, we thought that would be a great market to look at, but in reality, our brother Chris and Chris really runs the company, and we were over there in the early 2000s looking at some of the public companies and HAPs taking over them again. And so we've spent a lot of time there, ended up buying 14 stores in the southeast of England, added 1 to that since then. So we have 220 stores plus or minus in 3 countries, and we've done lots of things in this business. Let's go to the next slide, please. This is, again, just a lot of stuff that you can go through and read. I've asked David to go through and share these slides with everybody if they'd like them. It's not really a surprise. You can see where we're kind of broken down. We got 68% of our net rentable square feet in the US, 60% of our NOI comes from here. We've been very fortunate to be in Canada at the right time. That kind of works as a contradiction to the US, if you will. When the US is doing well, Canada tends to trend down and vice versa. So we didn't know that getting in there, but it's worked out very well for us. Likewise, the transition from the US into Canada has worked very well for us because it's very, very similar to doing business in the US. However, going to the UK was a whole different story, and we could do another 30 minutes just on the good and bad points of doing business in the UK. Let's go to the next slide, please. Again, this just kind of breaks down the type of properties, where they are. I mean, what we've looked at in building our company is we know those things. We know that you need that in order to get pricing power, you need to have penetration into the market. To get penetration in the market, it goes through and allows you to go through and get a much bigger digital footprint, which today means everything in the world to an owner operator of a property, because the digital aspect of our business today has dramatically changed the way we do business. 10 years ago, the only marketing decision we made was a full page or a half page in the yellow pages. And today we have 2 people that do nothing but bid on pay-per-click. We have 3 people that write blogs. And the rest of the people in the marketing department, I have no idea what they do. But I know it goes through and it helps us in our markets to have critical mass. The critical mass goes through and also gives us incredible synergies and great economies of scale. But more importantly, what it gives us is pricing power. Because something that we've seen through the COVID crisis, as rental rates and asking rates have gone down, to compete in the market, you may have to go through and meet some of those prices. But by some of the add-ons that we do, that Warren will go through and talk a little about, because he's been mainly responsible for our success the last several years in being able to build the check, not only from the asking rate, to go through it and see what we're actually accruing as a company. Next slide, please. Market cap wise, hey guys, if you add all these things up, Public Storage is still big, almost twice as big as everybody else combined. So, I mean, we're small. We're not public, thank God. We did that once, not for me. NSA has been an incredible growth story. They've done a great job throughout the country. But still, when you start looking at the companies that are out there, PSA is definitely the 600-pound gorilla. Next slide. On acquisitions, I think all of you all know and have followed a lot of the press. You know, up until COVID, even then, you started seeing a downward sloping line to the right, which my father-in-law, who was an ag econ professor, told me you got to have an upward sloping line to the right to be positive. This is not a good story, guys. I mean, it's been going down, but you got to realize if you painted the 10-year yield, 10-year treasury yield on top of this graph, it followed the same way. And we've known that in the 40 years I've been in the business, that cap rates for self-storage trend between 300 and 400 basis points above the 10-year. And this is exactly following. And what we've seen the public companies do over the last 4 or 5 years is become very disciplined. And I'll never forget when Ron Havner gave a talk at the SSA meeting in Vegas, said, if your cap rate doesn't begin with a 4, call me. Well, that's changed a little bit, and started looking at the numbers here to see how disciplined they are getting, because they realize with their cost of capital being where it is and their implied cap rates being above the cost of acquisition, that until cap rates stabilize, until we continue to maintain this discipline, it's going to be tough for them to go through and grow their companies, unless they go through and start buying each other, which has happened before, as we know. Next slide. You know, the two big things, I'll go into a few things about what's happened to us, but most recently, I'm sure all of you saw the announcement that Blackstone, or BREIT is what their legal name is, purchased Simply Self Storage from Brookfield. The backstory to this is that about 4 years ago, Brookfield bought all of the Simply Self Storage assets from Kurt O'Brien. Kurt has been in this business almost as long as we have. Good guy, great acquisitor, has done a good job acquiring his portfolio. Brookfield bought it for about 1.3 billion 4 years ago. Well, 2 years ago, they sold half of the portfolio to NSA for 1.2 billion. Now they sold the second half of the portfolio to BREIT for another 1.2. I'd say Brookfield knew what they were doing. They've doubled their money in 5 years. Not a bad deal. From our aspect of it, we've had one investor since 2006. And Stan Kroenke has been a fabulous investor for us. He's taken his wife's fortune that came from the Walmart family, who are from Columbia, Missouri, went to high school here, went to college here, just happened to start Walmarts in Arkansas, the neighboring state to the south. And Stan married Ann and has since doubled or almost tripled her Walmart aspect by his investment in sports teams. One of the largest operators of retail centers in the US, anchored by Walmart, one of the largest private landowners in Canada, which also led to our entrance into the Canadian market. So we've been very fortunate. And recently, we've decided to go through and take a few chips off the table, if you will, and bought a very minority, we sold a very minority interest in the company to Bill Gates of Microsoft fame, of Cascade LLC, of which he's the sole investor, and GIC, which is the Sovereign Wealth Fund of Singapore. I think some of you may have seen the press release on this, but what it does is effectively gives us dry power to purchase $1 billion worth of properties in the near future. We're really looking forward to getting this closed, which will get done this year. So their checks haven't cleared yet, but when they do, believe me, we'll let everybody know. Let's go to the next slide.
Yeah.
I'm gonna let Alex take over here because I don't know how many of y'all know, but we're very much a family company here. There are about 13 family members that all work together, all get along on most days. And Alex got his start, if you will, working with Heitman on the valuation side. And Alex came back 3 years ago and brought me into the 21st century on acquisition side. So Alex is handling all the underwriting, a lot of the work going forward. I'm going to turn it over to him to start taking over sessions like this.
Thanks, Mike. So, a lot of what was talked about earlier, I think really a big part of the story of the self-storage industry in recent years, when we looked at that slide that talked about acquisition volume by all of the REITs, and we saw 2016 was probably one of the hottest years for money to be invested. When you look at the performance of this sector in the years 2010 to 2015, if any of you had facilities at that time, it was year over year double-digit NOI growth on a same-store basis. Year after year, 12%, 13%, 14%. We saw all the REIT stock prices surge in values, 30 to 50% in some respects. And what did all of this, these incredible numbers being put on the board, drew a lot of attention to our business. Simultaneous to that, we saw e-commerce pretty much decimate the retail world, and all of the institutional money that was inside of retail and other asset classes started looking for a new place to go, and saw these incredible numbers that were up on the board. And the result was something that I know everyone here is probably experiencing to some extent, is everybody and their mother appears to have decided to build a self-storage facility somewhere in the United States. So, if you look at these headlines, COVID-19, we'll get into that later on. But although in the past, the biggest concern has been supply, I think going forward, the biggest concern is going to continue to be supply. We saw a 6 or 7 month pause in new starts when the coronavirus hit, but all that's going to mean is in 2023, there'll be 6 or 7 really good months for performance when we aren't seeing new deliveries. So if we can move forward. So here's a great example of how Storage-Mart's been affected by new supply. This store on the left is in Lawrenceville, Georgia, which is a great suburb of Atlanta. We developed this site in the early 2000s. It's a mix of ground floor, drive up and climate controlled self-storage, had great visibility from Sugarloaf Parkway, and has been in the high 90% occupancy levels pretty much since it opened up. 3 years ago, the parcel next door to us was purchased, and much to our chagrin, extra space opened up on our property line. And actually, if you look a little bit closer, we are sharing the same curb cut as our entrance to our 2 facilities. So, you have a competitor sometimes open up down the street. We had one open up right next door to us. It's not fun when that happens. Your operations can start to really significantly suffer. There have been a few marketplaces throughout the Southeast that have really seen some new supply come in a big way. So if you can move to the next slide, I've pulled 2 charts here that are outlining cumulative square footage of self-storage available over time in a marketplace, overlaid with the square footage per capita that exists in the marketplace. So if you see this period of time from 2010 to 2015, you'll see that new supply on a cumulative basis grew at a equivalent percentage to populations in each of these marketplaces. And as we were outlining before, in 2015 going into 16 was really the beginning of this new development wave, right? So we see the square foot per capita line really start to spike up and come up to where it's at today, where we have seen effectively what these charts indicate is that supply of self-storage is growing faster than demand for self-storage is. And these charts are for Greater Atlanta and Greater Miami, Fort Lauderdale.
And I'll add very quickly, this is not just 2 markets. Every single market that we operate in is at this point, in our estimate, probably oversupplied. I'm sorry, go ahead. It's not just these two markets, it's every single market in the US and approaching the same in Canada.
Yeah. If we'll advance to the next slide. This is what happened to our specific store in Lawrenceville. So if we look in the top left-hand corner, you can see Extra Space opens up in 2017. So really what's going on between 2010 and 2017 is us and a couple of our other competitors are really the only storage facilities in the market, and no new supply is built from 2010 until 2017. In 2017, Extra Space opens up, and the supply in the immediate 3-mile radius of our facility has now crossed and significantly increased. So the result of that coming off of 2017 was not dramatic as you might initially think. You can fight and defend against a new store that opens up. So did we see occupancy dip a little bit? Yes, we did. Did we see same store NOI growth come down a little bit? Yes, we did. Our actual rent per square foot, we actually were able to defend pretty heavily. And I think that was probably a result of the systems that we use in place with our in-place rent increases to our customers. But also, the first thing we did when Extra Space opened up next to us is we opened up our wallet and we spent money on paint. We spent money on our driveways. We spent money on our doors. We updated our facade. We put new signage out on the street because we realized that we had someone who was brand new right next to us with Class A amenities, and we needed to bring ourselves up to snuff. The customers rewarded us for this, and our occupancy today is still floating right around 90%, despite the fact that we've got a monstrous facility that is leasing up, sharing our driveway.
And I'll say the 250 to 300,000 we spent on these upgrades more than paid off for us.
Absolutely. This is a little bit out of, actually, no, it's not. If we'll move forward. So we talked a little about what happens with supply. What's really been going on with demand? I think the coronavirus has been a really interesting phenomenon for the self-storage business, because there have been a lot of headlines out there recently where if you read the public company reports, they're talking about occupancies are looking great. We're seeing decent same store growth figures. But if you dive into what is causing this, demand is actually down for self-storage. So if I'm looking here, I'm seeing my move-in volume, and this is all of Storage-Mart. So my move-in volume is actually down a little bit across my same store pool, but my move-outs are down significantly. So on the churn, I actually have higher occupancy on less move-ins because people, for whatever reason, have stopped moving out of our facilities in the way that they used to. And this is interesting because this is not unique to any one marketplace. There are a lot of different things going on in the United States where you have places like New York City or, the Bay Area that are significantly locked down in comparison to, Georgia and Florida. And even in these areas, we're seeing less move-outs and less move-ins. But because we're having less move-outs on a net basis, we're actually renting more units. We can move to the next slide. So it got pretty bad there in the beginning with COVID-19. Our first reaction to all of this was the last thing we want is a headline that goes viral somewhere that says Storage-Mart sold the unit of a first responder who was working a 30-hour, consecutive shift in the hospital on the front lines of the coronavirus. We said, we're not going to increase rents. We're going to stop doing auctions. We're going to hunker down. And we actually increased the pay of all of our managers by $2 an hour as, hazard pay in the heat of all of this. As the state started to open back up, we started to open our systems back up. So, and I would encourage everyone who's on here, if they have not started these policies back up yet, that it's safe to do so. So effective July 1st, we're now collecting late fees and rent increases again to our existing customers. following a suspension. We put out our first set of in-place rent increases. They averaged almost 10% on July 1st. That was actually a very specific number that we chose. We said it has to be less than 10% because there still are a few states and counties and municipalities that have implemented price gouging rules that state, you know, if I increase something by 10%, I could get in trouble. And I'm sure Scott Zucker will talk about that later on in this presentation. It was interesting though. Our customers really didn't push back much on it. They continued to pay their fees and they took the rent increases just fine. We did see some delinquent accounts spike up, but our managers have been really good at managing that and getting our auctions through. And we're, you know, a little bit higher than we were at the end of Q2 2019 at 2.2% delinquent versus 1.4%. But when you look at a few companies like Extra Space actually had about 7% on their books at the end of Q2. So we're very proud of ourselves in the way that we handled that. Google search demand is beginning to surge back and trend above 2019 levels. And we've seen our occupancy rebound in a way that we're all very, very pleasantly surprised by. So from where we're sitting today, the last 3 or 4 months have been very strong for the company. But the lagging indicator that's still out there right now is asking rents and getting those back up. We can move to the next slide. So something we pay a lot of attention to, and I'm sure everyone around here is familiar with it, is the idea of a 3-mile trade radius saying, this is my marketplace for a self-storage facility. It's an easy metric. Everyone knows how to talk about it. But when you start to dig into it, I think we all really know that our facilities, it's not as simple as just drawing a 3-mile ring around my facility, right? In this case, where we're looking at a store on the West Coast, if your ocean is to the west of you, the 3-mile radius isn't really worth much. We have found, and we actually go through on all of our facilities now, and we're starting to draw oddly shaped amoebas to define our trade areas based on where our customers are coming from, instead of the 3-mile radius. And
this helps us likewise as far as the digital marketing, where to pattern things, where to promote things.
Yeah. Understanding your customer base is even more important in the digital advertising era. And spending your money the most effectively when you're bidding for keywords is incredibly important. This allows us to do that. It also allows us to dig in and really dive into what exactly are the types of customers that are renting from our facilities. If you could move to the next slide. So this is, we have gone through, we've defined trade areas for every single one of our facilities, and then we've stratified them against each other. So if I have a group of facilities that I've defined are in urban marketplaces, so that would be, let's see, I've got a store in Brickell in downtown Miami. It's an urban site. I have a store in...
This is Oakland.
This one's Oakland. It's an urban site. I have a store in Fairfax, Virginia, which is closer to urban. And they're all ranked against each other. And we look at all these values and we say, how dense is the population? Is the area growing? How educated are the people that live here? To what extent do they own their homes? And how much money do they make? And we use this information and we're constantly running queries to say, where are their correlations? How well will somebody who has a high income and is married accept a rent increase compared to somebody who is lower income and is not married? In a denser area, should I have a unit mix that is different in an area that I have a sparse population? In an area with, on income, it's really important for marketing. We found that in lower income marketplaces, the most important keywords that you should be bidding on are no credit card required, cash accepted, no deposit. In higher income areas, you should be bidding on first month free because people are more concerned with getting a deal. Clean, safe, well lit are other keywords. So it's interesting when you slice and dice. You really need to cater directly to the people who are working and living in your trade area. If we move forward, here's, I think, a really interesting slide on the next one. that indicates how this can show up. So I've pulled 3 stores here that are in 3 very different places. So Northbrook, Illinois is north side of Chicago, very high income, suburban, big units. Springfield, Missouri is a blue collar town in the Ozarks, and Merriam, Kansas is a suburb of Kansas City. So kind of a mid-major marketplace, middle side of the income. We have found that there's a direct correlation when we look at income and marriage rates in your population as to how long a customer is going to rent with you. So if I'm in a very high income area like Northbrook, Illinois, and where 2/3 of the people are married, we found the length of stay is about 10.3 months for my average move-in. If I can move all the way down to my blue collar side of things in Springfield, Missouri, where it is very different than that, it's actually almost half. So when I'm looking at these 2 stores and I'm thinking about, should I give a new move-in the first month free, that first month on the lifetime value of a customer in Springfield, Missouri is going to cost me a lot more than that first month in Northbrook, Illinois. Some other things that we've been able to derive from the data that we're finding from our customers, if you move to the next slide, and I think are really interesting, are, when did you move in? So if I'm looking up here on the top left on seasonality, chances are if I move in the rental season, I'm going to have a lower percentage survival rate over time than someone who moved in the off season. Whether or not I've required somebody to take my protection plan or my insurance policy actually has a direct effect on how long they're going to stay with me. Customers who rent climate controlled units stay longer than customers who don't. The drive up unit, we talk about this all the time, and I'm wondering why. It's because it's easier for me to pull a truck up to the unit and unload it and move out, and I don't have to use an elevator. I'm really not sure, but I think it's a really interesting stat. But really the biggest one down here, and by the way, was also our saving grace during the height of the pandemic, is auto bill. So if you're not doing it today, you need to spend as much of your time as you possibly can on getting your customer base paying by credit card and signing up for auto pay.
I have to say that we had 85% of our 120,000 customers pay on auto pay, and talking to some other friends in the business that did not want to have that many people on auto bill because they like to charge late fees, they're now pushing their auto bill up considerably as a result of the pandemic.
On a rent increase, I'm sure everyone here has a Netflix account. If you think you don't, check your credit card statement, because you might, and you might be getting billed $10 a month for it. It's similar with the self-storage unit. If you're on auto pay, it becomes that monthly charge, and if I push a rent increase through to you and you're on auto bill, there's a 50% chance on a higher basis that you're going to stay with me over somebody who received that rent increase and was not on auto pay, and they go to pay their next bill. So I think it's very powerful things. And then my last slide here, I'm sorry I've run a little bit over, is if we look at our current customer base how long have our current customers been staying with us? So 40% of our current customers say 90 days or less at our facility. If you talk to any of your managers, they're probably going to tell you that the most powerful tool they have on getting a rental is offering the first month free. If 4 out of 10 of your rentals are going to leave in 90 days, that's a really expensive 30 days. And we spend a lot of time and money on training our managers to do everything but offer a discount, because we know how valuable that is. And Warren is going to talk more about this later on, but the system that he's put in place at our facilities for revenue management and value pricing that allows us to maybe offer a little bit of discount, but build the bill back up by upgrading our customers into premium units, allows us to compete on this without giving as much away on an economic basis.
And You know, with that, we tried not to make this a commercial about Storage-Mart. We've always found over the years, the more you give, the more you get. We are very actively recruiting, obviously, new properties. Happy to talk with any of you all. We just want to plant a seed that when you're ready, give us a call. But with that, David, I don't know if you're going to introduce my good friend Scott, or you want me to.
I think next up at bat, we were going to have Warren.
Oh.
And just because the slides are in that order, I think.
Oh, okay.
If you'd like to introduce them, please. Otherwise, I have some notes I can introduce.
I think actually Scott's next.
Okay, very good. Let's go with Scott.
I mean, first of all, I've known Scott what seems like forever. I know he's a huge baseball fan, so he's been through a huge withdrawal this year. But if you don't get Scott's mini storage minute, or I'm sorry, Zucker's minute, whatever it is, seriously, Scott, I look forward to it every month that it comes out, because I can always learn something from seeing what you've written. And appreciate you being involved in this and being the legal eagle, if you will, to go through and help some of the other people on the panel. So Scott, thank you very much.
Thanks, Mike. It is always a pleasure to be on the same panel as you and Alex, and the information is incredible. I think you're the first one who referenced the phrase open the kimono, and you're on mute now, but I think you're admitting that is the honesty and credibility that the Burnam family offers to this industry is incredible, and I think the folks that are listening can really learn a lot. And I know, these guys have done this presentation for so many people throughout the years, but it really helps to learn about what we're doing and what we need to do and how to make it better and all that. My part of this program is very limited and tailored just to talk a little bit about the anxiety that's out there with COVID. Alex had talked about the fact that there's been an impact in the industry from the pandemic. Clearly there has. We've moved a lot, and I guess you can go to the next slide. We've moved a lot to the realization that self-storage is an essential business. And that was a troubling factor for a lot of folks when we had the shutdowns, is whether they could still open their facilities. And we respected those that closed for a short period of time, certainly supported those that stayed open, understanding that people needed to get to their property. From the legal perspective, I mean, there was a lot of concern about having a facility that was open and potentially being a contact location for the virus. It's turned out not really to be the case. We've learned a lot over the last few months. As Alex mentioned, things are open back again. We're seeing little areas of trouble in California, New York. We had a little issue in North Carolina. But as time goes on, we're seeing these emergency orders be clarified and the facilities move back to full operation. So Alex was talking about the rent increases and the price gouging laws that came into effect as part of the state of emergencies in all the states and the national state of emergency. And it was true. The concern about raising rents during the pandemic period created a lot of concern about bumping up against the question of whether that's price gouging. We've learned very clearly that those states that have caps, the 10% that Alex talked about, is a good precedent to use across the board for what would be a reasonable rental increase that would commonly happen in the industry. So when they're talking about them doing the 10%, falls right in line with sort of the national expectation of not going over that 10%. Not that you can't. Other states have laws that are more subjective that talk about excessive and unconscionable rent increases. We're not seeing that in the industry. In fact, I think even Mike mentioned that pricing maybe has come down a little bit to ease the stress of using self-storage in relation to move-outs and transfers and things that are happening economically in the country. So if you're comfortable about raising your rent, certainly if you're offering a discount program, 50% off or 1 month free, your language of that deal offers you to go to your standard rate in that second or third month, and that 50–80% increase is not price gouging as long as it's clarified in your presentation to your tenant about the program, the discount program that they're entering into. Let's move to handling delinquent tenants. Boy, as they mentioned, there's a lot of stress about doing anything in late fees, overlocks, lien process at all against folks during the COVID process. In fact, there were municipalities that had certain restrictions about enforcement of debts against tenants by landlords. That's all been clarified in 99% of the areas and jurisdictions to understand that deals with residential use of the property. Self-storage, as we know, is non-residential, should not be residential, is focused solely on the storage of personal property, and therefore the eviction laws and restrictions did not impact self-storage operations, and you could proceed with your liens, overlocks, late fees, with comfort that you're not violating any laws. And then again, we've seen the opening up of the fact that the tenants are responsible for their rents, are responsible to pay. That's why I guess we're seeing, occupancies staying relatively high and debt delinquency not really being as significant as we had all worried about. So things are back to a little bit back to normal with respect to dealing with a delinquent tenant and those issues. Now, lien foreclosures, similarly, everyone had a lot of stress concerning the laws that came out about restricting evictions, the protection for tenants. Again, these go with residential use, not with self-storage use. You have to look at your particular municipality to understand if they had additional rules or restrictions that are in place. But generally across the board, you have the right to enforce your lien, your statutory lien over your tenants for their delinquency. Just sort of the comfort level. It's certainly, as Mike and Alex know, my policy and recommendation to operators all the time is the best deal is no sale. So if you can work out something with your tenant to have them vacate and collect something and to avoid the lien sale, then great. Do that, work with your tenants, certainly during this period of time. We've made strong recommendations with regard to the lien letters having language in there that if the tenant has been affected by COVID, by illness or by work, to contact the facility to work something out. So if you can settle the debt instead of doing a lien sale, great. A lot of discussion about that and obviously information about that. I wanted, before we go to the next slide, just to also include in this whole discussion from the legal perspective, and this is the stuff that Storage-Mart has done so well at, is bringing your facility, the need to bring your facility up to the technological age of contactless relationships. I know that's moving away from the local manager that lives on site, that has a personal relationship with the tenant. There's a written contract, cash delivered in hand. This has taught us a lot. COVID has taught us a lot about moving to a virtual contactless relationship with our customers for safety. And so your need to move your business into that age with the right kind of protocols and systems to allow for the contract virtually or contactless is really important, as well as payment, as well as communication with texting and email. If you're not doing this, then you're not doing what you need to do to have your facility meet the requirements, maybe in certain instances, the legal requirements of the relationship between yourself as a landlord and a tenant. And that really has been emphasized and sort of identified more clearly for us in a legal context as part of COVID. Let's move to the next slide. The issue then turns a little bit to the liability for operators that run their business. I put this up only as a quick reminder that there's a lot of information out there from OSHA as to how to keep your facility clean. There are even states now that will allow you to put up signs on your gates in your offices that understand that a customer coming onto the property assumes liability, risk of liability of COVID by coming onto your property. Even if you're not in one of those states, and many of the southern states have it, but even if you're in other states, there's nothing wrong with putting up signage, clarifying that the customer assumes that risk coming onto your business property. But on top of that, your diligence of creating a maintenance log of doing these cleanliness hygiene items, the sanitation of the property, will protect you from liability if there is a claim of contact tracing of COVID that developed at your facility. it's certainly possible, but your defense, your legal liability defense, is to show that you've been maintaining your property with these general hygiene actions. So we're just talking about that from a liability defense perspective for self-storage operators. And to move to my end here, because we're really, I know, risk of going over time, I've provided slides, let's go to the next slide, about the impact of the CARES Act for small businesses. And maybe Warren will talk about this a little bit. This is I'm not a tax lawyer, but the next few slides go through the reality that as a result of the CARES Act and potentially evolution of the stimulus packages and protections for businesses, there is money out there for operators who may be struggling as a result of financial impact to their business, whether it's by maintaining their employees on site that otherwise they thought they would move to part-time or have to lay off completely. There is a financial opportunity for you to keep your employees, keep your business, get short-term loans with very low interest rates offered by Small Business Administration and through the CARES Act. So the next few slides, so this is the Paycheck Protection Program. Go to the next slide. There's a bridge loan through the SBA. That's an express bridge loan for folks that need this additional support. A small business debt relief program. All this has been evolved through the CARES Act for small businesses, which self-storage fall directly within the definitions under the Small Business Relief Acts. Next would be the next slide, economic industry disaster loans that are available. Again, up to $2 million at very low interest rates. Not that I've seen a lot of self-storage operators that need that, but want to know that that's in your back pocket for financial support if you're having any struggles, but it's something that you want to be aware of. The next slide would be the loss carry forward. And it's a funny way about this, I think this is one of the most interesting aspects with respect to the ability to push some of the liabilities from past years forward. And if you're having the lower revenues that many experienced in 2020, the ability to deal with that as a tax opportunity for your facility. Again, I'm not a tax lawyer, but these are things from the legal side that I want to make sure that everybody's aware of. And there's one more, the last slide is an employee retention credit for you. If you're not using the PPP, if you've not applied for that, that you can get a 50% deduction based upon the keeping of those employees to help you through that period of distress for the pandemic. So that's a very short, quick summary of the legal world out there. Again, it's an honor to work with the Storage-Mart folks to educate, which is really the goal I know they have to make all of us a better industry, to sort of rise the tide of who we are and what we do. Again, thank you, Mike and Alex, for including me in this, and David, of course, pass it back to you guys and let you run with it.
So Scott,
yeah.
First of all, from the last few slides, I guess the old adage that I'm from the government, I'm here to help is actually true.
It's amazing what was in that CARES Act if you really read it, what's available. So
Wow.
It's something that
it goes back to what I said at the beginning. I mean, I've yet to talk to Scott when something good has not come out of it. And I've got a lot of people that I know that are suffering right now, that are having issues, and I'm going to pass some of this on to them. Scott's also too humble to go through and give a commercial for himself and the self-storage legal network that he and Scott Carlos Caslow had done for years. And I know that I was a huge user of the service, unfortunately, for many, many years. And Scott and Carlos have done a great job, and I suggest that especially for the smaller operators, and even for an operator our size, they help me out every month. And I almost can say I look forward to finding out all the problems that were in the legal industry and the storage business every month, but I did. David, do you want me to introduce Warren? Since we've been connected at the hip with Warren for, I don't know how many years, Warren. I know that I know that for years, Brother Chris went to apartment seminars, to industrial seminars, any place they could to go through and try to find a revenue management software. I mean, we were ready to write a check for almost any price. And I think Warren knew that because he picked a very high price when he talked to us. He's since gone through and worked that down. I have to say, lots of the charts, lots of the way that we think about pricing today came from Warren. And I mean, Warren is the person responsible for the person in the middle seat on American Airlines paying less than the person on the aisle or next to the window. And so we found a true rocket scientist. I mean, he's like PhD in everything, and he's gone through, I can't tell you how much we appreciate his insight, and has forced us to go through and look at things in a completely different way. And I just thought it'd be nice to have you all hear what he has to say about some of the pricing, what we've looked at over the last, especially during COVID, and what we're looking at for the future. So Warren, sorry, I stole some of your thunder, but go ahead.
No, not at all, Mike. First of all, thank you very much for overly generous words, I've got to say. For me, I've been involved in revenue management and pricing, dynamic pricing that is, since the mid-1980s with American Airlines. And for me, I've got to say, being on a session with Scott Zucker, Mike and Alex Burnam, I feel like I finally made it in the self-storage world now. So thank you very much. It really is a privilege to be part of this session. I'm looking forward to questions, answers, discussion. I've got only a few slides just to try to hit a few things that I think are important. I will say that as folks, if you remember, one of the slides that Mike and Alex showed about Storage-Mart's growth, or if you look at it afterwards, you will see that in about 2013, 2014, their growth accelerated. Now, I will make a casual observation that that's when we started working with Storage-Mart and implementing some of the techniques that they're using today. I will not say that we're responsible for the growth. I would like to believe, however, that by our efforts to help introduce data-driven pricing to them, it made their growth easier and it kind of helped that along. And I do believe that, when we started working with Storage-Mart, they didn't really have any analytics group at all. And now Kevin Bowman leads a group of about 4 people. They had, if I make a little bit of a joke, when we spoke to them in 2013, 2014 about Tableau, they thought we were speaking French and we were being very innovative about the word for table. And we had to tell them it was really, no, that's a business intelligence piece of software that's really quite useful. And now they went out, they got training on it, they got it. They are doing incredible data-driven analytics beyond anything that we're providing with them. I think we help that along, but I just want to put that in context, because as you start doing more and more data-driven revenue management and pricing, there's enormous incremental revenues that really can result, profitability can make significant increases. So with that as a backdrop, let's go to the first slide. And Mike was talking about pricing power. I've only got 2 slides really. I didn't want to overwhelm you with a lot of data. As part of our revenue management and pricing system that self-storage companies use, we every day collect prices on what are being charged. And I think we're collecting prices at about 25,000 stores right now in the US. What you see here in 3 markets, you're looking at Atlanta, Baltimore, and South Florida. All right, the South Florida is in blue, the Baltimore, DC area is in red, the Atlanta area is in green. We're seeing how prices over the last 12 months, and this is like the asking prices for public storage, Extra Space, CubeSmart, Life Storage, and Storage-Mart. So it's the average price for the stores in these areas for those firms have changed over the last 12 years. And just a couple of quick things to point out. What you can see here is that I'll say, at the start of the shelter-in-place orders in March and through April, and I'll say even through a bit of May, up to Memorial Day, you can see that there was a dramatic drop in what website pricing was asking. And it really started to recover in the markets at different levels, but it's around Memorial Day weekend when we started seeing a resurgence of demand And as you can see, for the most part, prices have recovered, at least as far as website goes. You know, if you look at South Florida, ground floor, climate control 10 by 10, so the graph to the top right, prices now are still a little bit less where they were a year ago. That's not true for the other markets, but it is true for South Florida for the ground floor climate control 10 by 10 units. So I certainly will not tell you that prices have recovered everywhere. They are recovering significantly since the end of May. And in some places, they are a bit above last year. But the point I really want you to be aware of is that those companies that actively manage their prices pre-COVID, during COVID, we're still, I won't say we're post-COVID yet, certainly, but those companies that manage their prices, let's call it pre the shelter-in-place orders and post the shelter-in-place orders, continued to actively manage their prices. And some of the companies would not have done that unless they had the data-driven revenue management system capabilities to let them know how much leeway they had with their ability to increase price beyond what those threshold prices were. You've heard from Mike, Alex, and Scott about price gouging restrictions. They're still in effect in certain states. And so it's that, especially for larger operators who have stores in multiple states, understanding the extent to which you can increase your prices legally become really important. Again, what we saw is that in March, April, and May, most, if not all, I'll say almost all self-storage operators either rescinded or certainly did not input rent increases in those months. Beginning in July, and then certainly in August and September, those rent increases across the industry started to get more and more prevalent. I would say right now, we're probably back to virtually all self-storage operators now are implementing rent increases, even if they're a little cautious about how high they go with those rent increases. One thing I will mention, and this goes to some of the length of stay observations that were made before. If you raise your rents less than 6%, unless you really know which leases are needing to be raised less than 6%, you actually run a very strong risk of losing revenue because of the rent increase. Because when people get a rent increase notice, a certain number of them will move out just because of the rent increase notice, regardless of how much that rent increase is. And if your rent increase is not large enough to make up for that loss of business, you won't make it up from the leases that stay. And so that trade-off happens at around 6%, 5-6% or so. So just to kind of keep that in mind. If we go to the next slide, and then I'll finish up so that we can go to questions. I have one slide here that I thought would be interesting, and this was for the South Florida area, because this was one of the areas that I'll say hasn't quite recovered from the prices over the last year. We took a look at online prices. These are for the 10 by 10 ground floor climate control units for 5 of the companies. One thing I will need to mention is when you're looking at any kind of data on online pricing, you need to take it with a little bit of a grain of salt. When we started working with Storage-Mart in about 2013, 2014, they were the first company to introduce our dynamic value pricing approach, which allows them to get higher rents when people move into more convenient units in each unit group. And some self-storage operators always did a static approach of that. They took a few units near the elevators. They would separate that out. They would charge a higher price. But when those were full, all the other units in that unit group, the 10 by 10 ground floor climate control, for example, were all priced the same. we implemented with Storage-Mart, I want to say about 2013, 2014, a method where they could actually get higher rents if people moved into more convenient units. When we introduced it, it was a fairly novel concept. There was actually a concern that all their store managers wouldn't be able to implement it. It would be too difficult. They tested it at about 30, 35 stores, and they started making so much money from that. And Mike, I hope you don't mind my saying that. They started making so much money from it that they said, we need to stop and reprioritize. We've got to get this rolled out across the entire portfolio, which they did. And companies now generally making anywhere from about 4 to 9% incremental revenue. Storage-Mart, as you might imagine, is one of the companies at the top of that spectrum because they do more with their training of staff. They take it seriously. They do a lot of things to make that program more effective. In fact, one of the things that especially has happened in the last few months because of all of this pressure for contactless rentals, they started offering upgrade opportunities through the call center. And they started finding out, again, 60 to 70% of the people would upgrade on the phone call. And I will say, just so you know, other companies are doing this as well. 5-Star Storage, Ben & J Kendricks, they work with Go Local on the online process, where now when somebody makes a reservation online, after they make the reservation, to avoid website clutter, when somebody makes a reservation, a screen will pop up and say, do you want the regular unit, the more convenient, or the most convenient unit? And they're seeing a number of upgrades come through that. So all these mechanisms are leading to more and more revenue, which again, I just want to emphasize the importance of those upgrade rates are not necessarily seen on the website. So what you're seeing here on the screen really shows the posting price. And what's important to remember is companies may be using their website as a demand capture. So especially if you're in lease-up mode, you want to get a website price that makes sure people will be thinking about you, and then you can start with how many of them will actually move in at that rate versus upgrade rate. So again, you can see here a little more detailed at the company level. You can start looking at how in early to mid-March, prices on the website really started to decline for each of these companies in the South Florida area. And then right around Memorial Day weekend, that's around the 23rd, 24th of May, they bottomed out, and then you start seeing increases on this. And again, this is only one market, one particular unit group. Certainly differences by market exist, but this is a typical trend that I thought might be just interesting to see what was going on. And you can begin to see that if you look at Life Storage, for example, from early May through early August, there was a pretty constant price in there. Whereas some of the other companies were doing much more active increasing and lowering prices on the website. So again, it's just wanted to kind of highlight that to make sure everyone is thinking about when you are doing your pricing, you really need to be thinking about who your competitors are. I will leave you with one last thought before we go to the questions, I suppose. But actually, I'll do two last things. I never can do just one. Two last things. One is you can actually incorporate the rent increase process with the convenience level knowledge, and you can incorporate that into your rent increases, because it's generally true that the people who are most service sensitive and want those more convenient units, you can be a little bit more aggressive with rents, and that gives you, again, another way to get a little more in profitability. I've lost track of what I was going to say for my other thing, the other items, so you can get away with it now.
Well, Warren, add on to what you're talking about. Our average increase in revenue per unit is approaching $16 to $18 over what our normal pricing is as a result of what he's talking about. You know, the other thing about that, what Warren's responsible for, not only is a nice guy and a very smart guy, he's single-handedly responsible for increasing our NOI, but more importantly, he's also increased our overhead because we've had to hire so many people to do all these graphs and all these charts. And I think the real answer is that he's made our beautiful, simple, wonderful business incredibly complicated. And one thing that I guess that we have had the benefit of by getting bigger is that benefit of scale, to be able to go through and look at these type things to help us understand our customer better, help us understand our market better, and therefore go through and deliver a much better net operating income to the bottom line. And with that, I'm open for questions, and I know Scott and Warren are more than happy to answer questions for the next few minutes. David, I'll turn it back to you.
Thank you. I think everybody did a marvelous job of being interesting and succinct. And it is time for questions and answers, so we're happy to take questions from our guests.
So what do they just email or ask? How does that work?
Everybody can unmute their phones if they want to ask questions now. We will be providing links to this entire presentation and the slideshow a little bit later with everybody's contact information. So if you think of a question at 2 o'clock in the morning, we'll be here for you.
I won't.
This is John Spiros. I'm a broker with Ackerman, but also about 20 years ago, I realized that while I love commissions, I like recurring income. So I got in the self-storage business, and we developed under Storage USA, which then became Extra Space. And we still own 2 facilities, a big one in Fort Lauderdale, and just very similar to your one at Sugarloaf, a venture between Public Space and Trammell Crow is doing a 5-story with parking literally 200 yards from us. And we looked at investing in that, and I think they were, pro forma rates were, $26 a foot. And I'm sitting here in a nice facility at 19, and I'm hoping they bring it on. And I hope they get 26 a foot. But that's just kind of interesting to see how the competition works. But it all boils down to you pick the very best locations with limited competition. You always can you always seem to squeeze the most NOI out. But I'm interested more in what Warren's doing to see if I can squeeze a little more out of it.
Well, I'm sure that Warren would be open to that. I mean, I've always said that you're right, location, location, location. We're still in the real estate business, but you got to be able to smell McDonald's and see Walmart. And I also think what you're going to see, especially in the South Florida market, because there's been so much new competition down there, that what they can pro forma at 26, be prepared for about a 25% reduction on their asking rates until they hit 65%. Then they'll start going through their existing rent increases. So it'll be interesting. But like we said, I mean, spend a little money, sprucing your store up, doing everything you can to make it look a lot better. If you got a big one down the street, you're going to be able to offer things differently than what they are.
Well, that's good advice, and we're doing that. I will tell you, we opened this facility in 2009 or 2008, which just couldn't have been any better. At the time, the rates in the market were $24 a foot. I think we opened up at 16, and managed to hold on to it and keep it.
Yeah.
But we're now at about 20, and would like to move it higher. But I want to be the guy you got to drive past me, and I want to look like the shiny new penny as well. And if I can, as long as I keep the cash flow positive. But the competition is what scares me. I do think we are getting overbuilt in a lot of these markets. People say, "Oh, I need to do this," and really, if you can find something today where you can do single story, it's just those are home runs because the multi-stories, at least in Atlanta, if you're not getting $17 a foot when you're stabilized, you're not making any money.
Yeah. Well, you can either reach out to Warren and he'll show you how to increase your asking rates without doing so, or reach out to me and you can retire.
I do think
82,000 feet, $20.
I do think you bring up an interesting point, though, because customers, we all know that customers don't want to use elevators, right? If you can, you're going to want to pull up to your unit in your car and load it that way. You're lucky that your new competitor is Public Storage and Trammell Crow designing this site because they know how to design a multi-story site. There have been so many people that don't have experience in this business or understand how a site should be laid out, how the amenities should be taken care of, and the unit mix that they should have in place. So, if I'm in a suburban marketplace or somewhere in South Florida, typically speaking, my customer base is going to want bigger units. And if I'm a merchant developer, we all know that smaller units get a higher rent per square foot. So you're kind of at odds on, setting up your lease up pro forma to succeed and maximizing your revenue, because so many of these people are putting together small unit mix stores that look great when you take it to a banker, but when they get to 40% occupancy, it will hurt the whole marketplace because you're not leasing up all those small 5x5s you put on the third floor. So what do? You cut your rates in half. And all of a sudden, that's going to hurt everybody all around you, right? So when new supply is coming on, doing so in the right way is every bit as important.
Yeah, I've kind of in my career learned that, you can make any spreadsheet look good, and I can put that banker's mix in there, but if I got to sign the note, that's a whole different animal.
You bet.
And although this is a topic for another day, I will tell you that for many storage operators, the focus on GPR actually results in them earning less money than they should, because it affects the way they think about their pricing and the way they will do their pricing in various property management systems. And I won't go into details on that unless we really want to, but I will tell you, it's something in the industry that is actually a bigger problem than many operators realize.
I have one other question. I am seeing, I'm not sure it's with COVID specifically, but this whole move to recreational and, boat, RV, trailer storage. Are you guys, Storage-Mart, getting into that? What do you see the future of that business?
Well, typically it costs you as much to build a 14 by 40 as it does to build a 10 by 10 per square foot, if you will. And you're getting a lot less money for the 14 by 40 than you are the smaller one. We were in a market, Alex and I last week, where the average size unit was a 14 by 40. I mean, the square foot per capita was approaching 20.
Yeah.
Because every unit was huge. And we asked one of the operators we were meeting with, he said he purposely went through on a new phase, put windows in the garage doors high so he could see what people were putting in there. And he went up on his ladder and looked in the windows and said, it's just full of stuff. I mean, it's motorhomes, it's camping trailers, it's snowmobiles, it's ATVs, it's everything in the sun. And it's just been shocking. One of the biggest thing, there's a lot of positives and negatives as a result of COVID, but it's blown us away that how you can't buy a boat, you can't buy a Sea-Doo, you can't hardly buy a car or a truck right now any place because COVID has gone through and taken all the inventory. And one reason why we think that the economy is on the verge, regardless who comes in, I'm not going to even talk about that, David, regardless who gets in next week, the shelves are empty of all of the manufacturing places, and everything has to gear back up again to go through and just feed the people that we already have. So we're on the line for a good recovery, regardless who gets in. But as far as the RV and boat, I can tell you, I'm going to say probably 20% of the people I talk to have asked about building, 3-sided covers for RVs, etc. Because there are a lot of people. The further you go north, the further you get close to national parks, if you will, parking areas where it doesn't get so bloody hot in the summer, that's where we're seeing a lot of the growth. Perhaps you're starting to see some of that down south too.
Okay.
Well, you go ahead. Talk about.
Well, I do think it would be something to consider, though. As we talked a little bit about political risk. Candidate A versus candidate B. The discussion surrounding capital gains tax and the possible elimination of a stepped up basis in the calculation of your capital gain upon, when you pass away to your heirs. That is certainly something that I think a lot of facility owners probably need to keep in mind. I know when I speak to Mike all the time, his biggest complaint about the national SSA is that there are not many estate planning seminars that are put together for owners, because if you look at, I think, what were you saying, the average age of I
think it was 62 was the average age of the Self-Storage Association member. So everybody's going to be looking toward that date sometime in the future when they're going to have to divest of their assets, putting into a trust. And Scott's going to be better versed to talk about this than I would be. But we've seen a lot of people coming to us that their kids don't want to get into the business, et cetera, that we can offer them some tax deferred methods, because we are now going to be a private REIT. We can offer the same OP unit deals that any of the public companies can do, and probably offer a little higher even dividend than some of the public companies. So all of those things start making a difference as we all get a little older.
I got to jump in for a second and just emphasize the succession planning that's needed in our industry with family businesses like this. I just did a session for Inside Self Storage that you can go to. I'm not plugging it in any way, but I just did a program about succession planning in our industry, and I hope people are thinking about that. And I just reiterate exactly what you're saying, Mike. I mean, it's so important. People are being caught off guard about what happens to their business if their kids don't want it. I love your phrase, you could retire now with a phone call to you. That's great. It's a lot of money, but if they're not doing that, they got to think about succession planning and I just did that session for ISS, so it's right on topic.
Agreed. Yeah, completely.
As far as next week goes, I think the best outcome from a cap gains perspective is continued gridlock and a split Congress, regardless of what ends up happening.
Yes.
We will all see if the promises for elimination of that stepped up basis end up being true or not. But I think anyone's guess is as good as mine as to what ends up happening.
He just says that because he's in our succession plan. So
Yeah.
One thing I'd like to comment on before we end the session is, of course, to thank everybody for their time and the thought that went into this, and to thank our guests and our participants. And please feel free to reach out to us either in Atlanta or Baltimore or Missouri, whatever the case may be. But if this session was helpful, we may consider doing it again. I'm volunteering everybody's time without even talking to them, but I feel certain that they'd be willing to do it again and continue to try and find topics of interest that will keep people coming back.
very much.
No, it's very, very informative, and I really appreciate everyone's time and input.
Anytime.